Stocks are up 8 straight days, running into a 7-week winning streak. There are bulls everywhere on Wall Street. Everyone is running. As a matter of fact, we're finding that there are 0 bears out there. And the biggest bear of all is actually joining our show today because he's got some news. He might be flipping to the bullish side as well. Welcome, everyone, to Buy, Hold, Sell. I'm your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, and in sunny and bitter cold Scottsdale, Arizona.
Under 70 is bitter cold, okay?
Bitter cold, that's right. Well, we'll have to have a fireside chat later on then. But with us today is the Chief Investment Officer of Unlimited Funds, Bob Elliott, who is coming back to Buy, Hold, Sell and give us his forecast and what he's thinking about for the markets. Welcome to the program, Bob.
Hey, thanks for having me.
You know, Bob, Todd buried the lead here because clearly, based on our last interview with you when you were quite bearish, it appears that you actually flipped. Tell us about it.
Yeah, I mean, well, it was 10 weeks ago.
Yeah.
When we got together. And I think at the time, what it looked like was a combination of Janet Yellen, Jerome Powell were pursuing a tightening path, and were accepting that a market-based tightening was going to slow the economy in order to bring inflation down. And I think since that point, they've done their own pivot. Whether you think it's a good idea or not, who cares?
Yes.
Right. When you're trading markets, who cares? You have to respond to the things that are in front of you. And in particular, starting with the QRA announcement on November 1st, it became very clear that Janet Yellen was going to back off the market-based tightening and the long end tightening. And then that was reinforced by how Jerome Powell has positioned it back in November 1st, and then again at the meeting last week. And so you put that together, and it's like, look, the overall picture is a stance of easing. Now, is easing when we've had an inflationary spike and unemployment's at secular lows and stocks are making new highs, is easing really the appropriate thing to do? I saw recently that, you know, we had in the last 8 weeks the biggest easings since either the bottom in 2009 or the bottom in 2020. But heck, like, you got to go with what's going on, and they've decided to ease, and the markets are going to respond in that. You know,
well, when you say easing, though, you're speaking on two different types of easing. There's the Fed, and the fact that instead of actually selling bonds, they stopped selling bonds. And then there's Powell and his pivot, which is now like the onomatopoeia thing. The Powell pivot was powerful, and combined, it basically forced equities to go up in value since there was no, you know, the wind was at their sails, not at their head. Is that basically what you're saying?
Yeah, I mean, if anything, I think equity investors will quickly forget or not notice the fact that long end bonds at the same volatility of stocks are up more since November 1st than stocks are. So what that highlights, this is not a story of, it's actually not repricing stronger growth expectations in the economy, which is interesting. And I think creates actually a forward-looking opportunity. What's been priced in is a big easing that's been reflected in the yield market, and that's flowing through almost directly into equities. Now, I think that's setting us up for an interesting opportunity, in particular in the first quarter, because what that means is we've had a big easing. Stocks have actually trailed high volatility or long duration bonds. My guess is we'll see a flip of that, because a big easing is the sort of thing that's good for stocks, but particularly bad for bonds.
And when you say the easing, again, tell our audience what you're talking about at the Fed.
Yeah, so I mean, I think the first easing was by Secretary Janet Yellen at the Treasury, and basically we all know that there's a big fiscal deficit. And the question is, how do you finance that fiscal deficit? And for a number of different reasons related to the debt ceiling, she was able to finance it selling short duration securities, and drawing on essentially the Treasury's bank account at the Fed.
Right.
She refilled that bank account selling only short duration securities, and in the summer indicated that she would start selling more long duration securities. but then walked that back on November 1st. And that's essentially, if you just think about whether you call it easing or not, the long end interest rate market is just a market, and it's buyers and sellers, and the Treasury is the big seller. And if the Treasury one day everyone expects to issue a bunch more bonds, and the next day they say that they're not going to issue, they're not going to pick up their bond issuance, that's a big change in the future expectations. And that's a big part. It's about half of what we saw in terms of that bond rally that started this cycle that really started on November 1st.
Well, yeah, you make a great point, but it's a point that I don't think many people have actually got their heads around. Was that the minute they were supposed to announce that they were going to be selling a whole bunch of 20-year and 30-year bonds, all of a sudden she got, no, not going to do it.
No, I mean, huge shift to bills, shift to bills. And this is the problem. Like, she'll, in an interview, typically the bond mix, this is a matter for like the technocratic Treasury nerds, right? They're like carefully, like with their sharp pencils, figuring out exactly what the normal ratios are. And what Janet Yellen did was said, screw that. We don't care what's going on with what the technocrats say. I'm just not issuing the bonds. And what she made in that choice, she made a policy decision about something that had previously been a technocratic decision. And that's a big deal because it means, because she sits in a political role, not a independent role, and she's now pursuing a set of policies that have meaningful influence on the macroeconomic dynamic. And you can imagine that she's highly incentivized to support policies that would be supportive to the current administration, particularly as it's entering this current political cycle.
Yeah, we talked about this, Todd, a lot.
That's a very I would say, that's a very opinionated statement, though. I mean, there's no factual. I know what you're saying, and it does seem that way, that you're going to have somebody in Treasury that wants to make sure the current administration continues, especially going into an election year. But if that's the case, and that leads everyone to believe that the Fed is going to cut rates, not because it's good for the economy, but they're just doing it to help the current administration. What are your thoughts on that?
I would separate the Fed and the Treasury.
I spent 30 years in DC, okay? And I know many people in all the various departments, et cetera, et cetera. And as I've been sharing, it's my favorite word now, Todd, sharing on this podcast over the year, that in an election year, for a presidential election year, behavior changes. And if you don't get with the program, your ass is out. We've seen that. I've seen it 5 times. I didn't think it was going to be Yellen, though, that was going to be the one who capitulated first.
Well, I think Yellen is in the position to be most politically oriented, right? Her role is a political role. Yeah, that's a very important thing to remember. And to the extent that she has flexibility, right? I think there's ambiguity, because if you go back, like, Mnuchin wasn't really playing politics in his debt composition. Really, it had been a long time since there was real politics being played in debt composition, really back into the 70s since the last time you saw it. So it was ambiguous. And I think, we got a pretty clear picture about what the policy mix is going to be. And at some level, you just got to accept it when you see that, which is the Treasury will play politics. And the thing that is important to remember is they have a lot of room to play politics. If, for instance, they issued no coupons, no duration assets over the course of the next year, the debt profile of the U.S. would move up from something like 25% bills up to 30% bills. 30% bills is on the higher side, but we had 30% bills back in the past. So she could literally pull the rug out of this whole thing and issue no duration and create a big bond bid if she so chose, and has the flexibility to do that. Now, I don't think she'll be that extreme, because I think that will be almost too obvious that it's a political set of decisions. But she can certainly nudge the economy upward from and bond yields down from where she sits.
Bob, last time we had you on the show, we asked a question about a recession, and you were adamant saying, oh yeah, the U.S. economy, where we'll go into recession territory.
You want to play that back for him, Todd? I was.
Oh yeah, please play it back.
Replay. Where are your thoughts now on a recession?
Well, any good macro trader has very strong opinions loosely held, and particularly loosely held when monetary policy and fiscal policy starts to meaningfully shift in the opposite direction. So I disavow all previous claims that the recession was immediate. So just go ahead and you can delete that section of the previous tape.
That's the thing about videotape. Trust me, man. 20 years on on business television. OMG.
And that's
I'm
fine.
Just glad that, there was no TikTok then.
Well, Bloomberg this morning, they even said Mike Wilson is flipping. Everybody's flipping to the bullish side.
Well, I think that I'd say there's two things. One, there's been a change in policy stance. That's all there is to it. You have to, either accept it or get out of the way. And so, I have never been a bear or a bull, right? It's dependent on the circumstances and dependent upon the market pricing. And so this is a good example of that, where people who got entrenched in one view or another, have not, really the realities haven't done well over the course of the last 2 years. Neither bulls nor bears have done well over the last 2 years. The people who have done well have been flexible and responsive to the dynamics at play. Now, the thing I would say in terms of being a bear, you can make me the biggest bear on bonds and on short rates. Now, that's a different conversation. But stocks, the U.S. economy is doing pretty well. And if anything, we just got a big easing cycle, a big easing injection over the course of the last the last 2 months. And for all the recession doomers out there, like a strong economy getting 100 basis points of yield easing and stocks up, 10 or 15%, like that's not like the fast path to recession. That's not how it works.
Yeah, that's fair. I was looking back, and you were also sort of adamant about that the market was pricing in 25% earnings growth in 2024 and 2025. And that was sort of your reason to be cautious, if you will. But monetary trumps EPS, is that the message?
That's for sure. Monetary conditions trump EPS, absolutely. And I think there's also, interestingly, right now, a flows dynamic, which is particularly advantageous on a forward-looking basis for stocks relative to bonds, because stocks have been depressed, haven't actually been as responsive to this easing as you'd normally expect, because there's been a big rebalancing dynamic in the market. If you look back through the course of this year, obviously long end bonds are down a lot relative to stocks. What happens if you're a big institutional investor? You have asset allocation targets, is you have to sell your stocks and buy your bonds in order to bring your bond allocation up by the end of the year. That is a big negative pressure on stocks relative to bonds that it's flowing through right now. But there will be a point, looks like it might even start kind of this weekish, where that pressure is going to start to fade, right? Which is going to lead to more buoyancy in stocks relative to bonds.
Yeah, you're describing sort of the perfect scenario if you're long, which is if you look at the short positions going into, let's just say 4 weeks ago, there's been a massive rip your face off rally in stocks, which then becomes a self-fulfilling prophecy because of the wealth effect, and that in households, 25% of the households, upper income households, own like 90% of the stocks. So then certainly the wealth, and then you have this huge amount of cash on the sideline. Where do you think? Are people going to sort of just say, 5% was great? Because almost all my money management clients are, we built about an 8% cash, getting 5%, and all of a sudden they're saying like, Toby, we have too much cash. I said, honey, you have like 3.5% cash. No, we need to, because of the dividends we're getting. I love to brag about my LPG tankers, but as I told Todd, I in my Roth, I just got like this $22,000 dividend from an LPG tanker that I didn't even expect. I forgot I owned it, and there are so many cool spots that you can be at here if you stay in the micro, because that's why we're a perfect couple, Bob, because I'm totally micro and I don't give a shit about the macro. And while everybody was dying, with the market, but there's this one other part we haven't talked about, which is the Magnificent Seven. Where do we go on that? Because in theory now the narrative is we're going to recycle those profits and they're going to go into other parts of the market. What do you say?
Well, I don't have much of a particular independent view specifically on the Mag 7 stocks. I mean, other than, historically, when you see stocks in the PE range that many of those are priced in, it's hard to achieve to accomplish those goals. Not impossible, but generally hard. I think what we're seeing right now is that is the breadth, and that's what I think is probably the most interesting thing that's going on here. Yeah. Is the breadth that we're seeing in the market that's moving away from the few stocks to, like Russell 2K, you walk in, it's up 4%, holy mackerel. And it's got, those companies, if we're actually in a late stage easing dynamic that's going on, you should, those companies have been beaten down a ton, right? Relative to the mega caps, which were, way above highs already. And so we likely should see some rotation and reflective of the fact that those companies, and it's not just the Russell 2K, it's, the financials and the regional banks. And there's a lot of pockets of this market that were basically priced in for very, very weak economic conditions and very, very tight monetary policy, where if that's the reality is not that way, then at least in the short term should really benefit.
Well, the Russell 2000 maybe is a great example. To me, it was very bullish that we were seeing some rotation. I mean, there's really no reason why some of these Russell 2000, good companies and financials obviously understood that part. But yeah, we flipped, adding some calls on the Russell 2000 simply because we saw the breadth coming back. I mean, when 21 stocks account for 81 and then 91% of the S&P 500. That's about as narrow as breadth you'll ever get. And you can ride that toboggan for as long as you can, but all of a sudden, finally, there's nothing left to short on the Russell 2000 side. The interest rates were coming down, therefore the financials were going to do better. And they were priced at 50% of their asset value, yada, yada, yada. I thought it was very healthy to see this rotation, because that meant that actually value mattered and stock picking mattered. And that means that the market was just not, AI sniffing the drugs. That to me was healthy.
Yeah, I mean, we forget that, typically the small cap companies are the highest beta companies, right? Like we've gotten sort of confused over the last 18 months that it's Mag 7 that are the highest beta companies, but that's not right. Typically those small companies that are living on the edge and where those incremental shifts in monetary policy were detrimental, but now beneficial to them, is where you see the biggest pop. And that's exactly what we've seen. And given the valuations that are still out there, some of these regional banks are still down. I've only recovered like half of their post SVB hits, you got to roll up your sleeves and get into the nuts and bolts, and we won't bore each other, but with that, but as an old banks guy, I look there and I say, there's a lot of pickings. And if I can see some pickings that sit in regional banks, then I'm sure there's lots of pickings that I don't even understand, across the Russell 2K and other places.
Right. Well, we're going to leave it there on that block, guys, because coming up after the break, since Bob is bullish right now, we have to ask him what he likes. Sectors, maybe some individual stocks, but we'll get into all of that right after the break. So with us today is Bob Elliott. He is the CIO of Unlimited Funds. Please stay with us.
And the boy can take a punch.
The boy can take a punch. Good job.
Buy, hold, sell, brought to you by CrossCheck Management.
Everyone loves Nashville right now. It's the perfect family getaway. But it isn't just known for its food, bright lights, and music. It's also known for football. The Trans-Perfect Music City Bowl is coming to Nissan Stadium on December 30th. Celebrate this new year with football right here in Music City. The music, the food, the fun. Spend your weekend in Nashville. It's your family's perfect start and end to the new year. Tickets are available now. Brought to you by Tennessee Lottery.
You make me sparkle. You make me tingle. Even the stars are brighter when I'm with you. And when I surrender to a tasty kiss or two.
Martini and Rossi iced tea.
You make me sparkle. Yes,
Make the moment sparkle.
Welcome back to Buy, Hold, Sell. Well, stocks are on a tear right now. Everybody's bullish, and we have the biggest bull of all with us today. We have Bob Elliott. He is the CIO of Unlimited Funds. You can go to unlimitedfunds.com to check out all the products that they are offering, which are sensational.
And his unlimited bullishness. Yes.
There you go. Unlimited bullishness. Bob, let's talk about the company a little bit, because I'm sure everybody knows about this $5 trillion in money market, right? And money market funds right now. All this money, a lot of people the fear of missing out. A lot of cash is flowing into the market. I anticipate we'll see even more once rates start coming down in 24. But for your company, are you seeing a big amount of inflows? I mean, you tell the audience.
Well, a lot of what we're trying to do is create a product that replicates what hedge funds are doing in terms of their positioning and their returns. And I think the thing that many investors looked at over the course, particularly coming out of 2022, was they said the safe place to be is holding cash. But cash has not been a particularly safe place to hold over the course of the last 15 months or so, as asset prices have risen. And I think a lot of folks have been burned by that. And so are looking for ways to get that agility, because the problem is you go into cash and it's like a roach motel. It's like tough to get out of cash, right? Because cash always feels safe. Assets always feel scary. And so one of the things that we think is really interesting and compelling is, instead of using cash to be safe and trying to time the market, hire essentially the most sophisticated thinkers that are out there trying to time the market, right? With all of the work that they're doing day in and day out, let them do the market timing. And you don't have to really, you don't have to think about that at that scale and that level, because as we've seen, like, look, this market timing stuff can matter on the order of weeks or months in a way that, the everyday investor, they're just not going to get it done. They're just not going to shift fast enough. And so I think, these hedge fund managers are quite compelling. And if you obviously very high beta stocks have done very well over the course of the last 15 months. But if you just go back over the course of since the Fed started tightening, there's basically only three assets that are up meaningfully, and that's commodities, gold, and hedge fund strategies. And that's because, hedge funds have been able to generate mid-single digit and a little bit better returns over the course of the last 2 years, but they didn't experience the same sort of drawdown. They didn't have the 25% drawdown. I was just looking today, tech stocks and hedge funds have delivered the same return over the last 2 years. But one went down almost 40% and one didn't, right? And so that's kind of the idea of letting these managers sort of direct how the capital is managed on a day-to-day basis.
And so you actually have hedge fund managers who are the asset allocators?
No, we infer what the manager's positioning is by looking at the returns, which we can see in close to real time and in a pretty granular, timely way. And so what we do is we use machine learning, look at their return pattern, and back it into how they're positioned. And part of the reason we can do that is because my co-founder Bruce and I have been in the hedge fund business for many decades, so we have a pretty good sense as to what they're doing. And so as we observe how they're how they're returning, what their returns are in close to real time, we have a pretty good sense as to how they're navigating through these environments.
So Bob, with that, when you look at those hedge fund returns, I mean, you and Bruce, very smart guys. I'm sure you're looking at the Sharpe ratio. You're looking at how much risk these managers are taking. Do you see these managers adding risk, even though the returns are up double digits?
Yeah, so hedge fund managers have been a bit more conservative than certainly index investing over the course of the last couple of years, which has actually paid off very well over those years in terms of generating a pretty good return without the meaningful drawdown that a lot of folks experienced that forced them to shift to cash, right? Mm-hmm. A lot of people shifted into cash right at the bottom, and that was the worst thing that they could have done. And so these managers, this is what hedge fund managers do when times are volatile and uncertain. They're conservatively positioned, trying to generate a modest return until you get to that point where the cycle breaks and it's clearer, it's more going in one direction or the other, and where they can lever on more bets. And what we have seen over the course of the last, eight or 10 weeks is that these managers are picking up the amount of risk that they're taking, really directionally moving it in the form of long equity positions in a bunch of different ways. And that's pretty interesting because they've been the real laggards in terms of equity bullishness over the course of the last 15 months.
Bob, the one number that I always get every year is the average hedge fund return. And the average hedge fund return 1 year, 5 years, 10 years, 20 years has seriously lagged the overall market. Now, what they did great in was that they were much lower volatility. I get that. But in essence, you guys have created a system to sort of cherry pick the hedge funds. And then from the hedge funds you cherry pick, you're able to infer what their positioning is because of their relative. But how do you get the relative performance? Is that a database you tap into, or do you guys just steal it? I mean, I didn't mean that.
We do not steal it. No, there's a bunch of performance aggregators that give you a pretty good sense as to what there's sort of 6 or 8 of those that are out there. And the reason why that is hedge funds are always trying to benchmark how they're doing relative to other funds in their category or the overall industry. And so we're just leveraging all of that reporting that they're doing to all these different performance aggregators and using it in a novel way that's, not what people typically use it for. So we actually have very good, very timely understanding. I think going back to your first point about how hedge funds seem to have always underperformed the market, totally right. If you look at the index performance information, you'd say, not that great a return, all things considered. But the reason why that is not because these hedge fund managers have a strategy problem. Their strategies are great. They have a fee problem. And so if you charge 2 and 20 fees, of course it doesn't look good. But what we're doing is, because we're using technology to infer what they're doing, there's no star PMs to pay. Right. So we can offer it at a much lower fee structure than what those 2 and 20 managers are doing, and in a much more tax efficient structure like an ETF that makes the post-tax, post-fee return much more compelling for the everyday investor.
Yeah, there's no question that what I loved about reading about your strategy was just that you're not starting, if I'm giving you my money, I'm not down 20% starting on January 2nd because
that's right.
Because every profit dollar you make from it, you're taking 20%, you son of a bitches. Even when I had a hedge fund, I couldn't look somebody in the eye and take 20%. I could do 10% of the ups. But of course, I'm not like the typical hedge fund manager who has 2 divorces, 2 houses in the Hamptons, 5 kids for 3 different women that they're paying for.
When Steve Cohen was managing money, he did a 3 and 30 deal.
Yeah,
he was taking 30% of the profit. So
and Millennium, with all of this fee charging to the fee pass through stuff, some of the clients, you talk to them and they're like, I think it's 7, I think it's 8 and 30 and a 5-year lockup, and you're like, holy crap, how are you ever gonna 7 or 8 and 30 and 5-year lockups is like pretty tough. That's a pretty tough hurdle because there's, alpha is uncertain. Fees are pretty certain, right? You pay 700 basis points in fees. It's pretty obvious what's going on. Alpha is a lot harder.
Bob, would you, for the audience sake, just define what alpha is and what beta is?
Alpha just
Sounds
means
like you're talking like Spock to some people.
all alpha means you can make money in two ways. You can buy assets and just hold on to them and do index investing, and you expect that to have a positive return over time, because if it didn't, you shouldn't give your money to people who are using it through borrowing or issuing equity. So that's what we call beta. Alpha is outperforming relative to that index investing, and so that's really what hedge funds are focused on. They're not focused on generating index-like returns. What they're trying to do is generate returns that are in excess of what those indexes are doing. Now,
with less volatility.
With less volatility. That's exactly right. So that might be the same return. Like if you look at hedge fund managers in general, they actually target a return that is a return level that is about on par with stocks, but they try to do it about half or less of the monthly volatility and about a third of the drawdowns. So you just have a more consistent return. It's also not 100% correlated to stocks, so it's diversifying in a portfolio.
Yeah. Okay. Well, I understand at the pension level, it makes a lot of sense. I still the 3 and 20. I mean, look at Ken Griffin or whatever.
Oh yeah, Citadel.
55% a year. I mean, but he's making it as a market maker. He's not even buying.
Yeah, that's not hedge fund money. That is market making. Same is true for Renaissance. Anything that's that consistent, those are market making. So yeah, I mean, it's like a tale as old as time. What's the best position to be in is to be on both sides of the trade and be the market maker. So if you can do it, good for them for being the market maker. But if you're betting long and short markets, most of the return is pretty, it's in many ways kind of boring relative to, that. But that's the idea: stock-like returns with a boring path, which is, pretty compelling for a lot of investors.
What do you guys? Excuse me. What do you guys do, or do you have any interest in dividend ETFs or dividend? Where the return is much more dividend based than it is equity based.
Yeah, not so much, because most of these managers are thinking about exposures not really around a dividend cut, but they're thinking about attributes of the companies, because they're kind of agnostic to the source of return, whether it's dividends or whether it's capital appreciation. And so they're not really that's not like a big focus the way, I think for a lot of advisors, income matters for their clients and when they're thinking about it. And so it's sort of more appropriate for them, I think, than what the hedge fund managers are thinking.
Todd, that's why I'm never going to be a hedge fund manager again, because like 40% of my returns every year are actual freaking cash money dividends. Things you can spend, things you can pay alimony checks with.
Yes.
And I just to be only long, stocks, or only short when you can get now these crazy dividends. In the old days, you couldn't get dividends like you can today. People thought that the managers thought they were smarter than the dividends, so they just kept reinvesting. And finally, some of the companies finally said, how about we just buy back stock and pay dividends? And the stocks are going to go up more, and our people are happier. But that's a subject for another day.
Yeah. No, I thought you wanted to be a manager so you could buy the Mets one day, but we'll worry about that another time. But
Stephen Cohen, trust me when I tell you this, he's not he doesn't go for the dividends.
No,
and who would want to buy the Mets? That's the real question.
That's right.
Let's move on.
Just because you grew up in Queens does not mean that you want to own the Mets. And then put $120 million out for players who underperform. I'm an old Dodger fan, okay? So when we got Ohtani, I'm like, awesome. When I found out that he's only taking $2 million a year, and they're deferring $70 million a year, holy mackerel! Now those Dodgers are.
But remember, what's interesting, he grew up in an area of the world where they have negative interest rates. So he has zero appreciation of the time value of money, that compounding.
That's right.
So for him, he's getting $50 million in endorsements anyway. So he's deferring, but think about what he's losing just in interest alone. But Bob, before we close out the show, I have to ask you, favorite sectors. What do you think? You mentioned commodities, gold earlier with the hedge fund managers. What do you think going into 2024?
Well, I think the biggest mispricing in the market has got to be in the short rate market. Take a look at what's going on in the short rate market right now. We see 150, 160 basis points of cuts priced into 2024. And I look around and I say, for what reason? Like why are we cutting? Why is there such a substantial expectation of cuts? Now, look, the Fed has said maybe they'll cut 3 times on the dots, but that's only 3 times. That's not 6. That's 3. That's not 6 or 7. That's 3. And they're probably one of the more dovish players in the market right now. And so the real question is, where are those cuts going to come from? When I think about what's going on, the economy's growing above potential. We just had a massive easing easing injection that's come in, and unemployment's at secular lows, and inflation is moving down, but it's not. The Fed hasn't met its mandate yet. Certainly not the sort of time to be swiftly easing monetary policy. So economic conditions look okay. Inflation is still a concern. Where are all these cuts going to come from? And I think the market's a bit over its skis on this.
Yeah, Bob, I was going to ask you as a final question, but sort of that same deal. If in your previous life, 40 days ago, when you were bearish, you could have made the case that, well, because we're going to have a recession, that the Fed would cut rates. That's their only, blunt instrument that they have. That was before Ms. Yellen decided to flip the entire script. But I don't understand that we're going to get. 7. I don't know what they're smoking over there. 7 cuts. I could make the case that at the margin, incrementally cutting 75 basis points, 0.75% at the Fed funds rate makes sense. But next time we have you on, I'd love to have a discussion about why the Fed funds rate doesn't mean squat anymore. It used to be the end all be all, and yet it doesn't move the needle really much at all, because there's so much private equity. There's so many other lenders out there that are not based pricing off of them. That's for the next one, if we haven't put everybody to sleep so far on alpha and beta.
Well, I think that's the big question, is where, if you look at that pricing too, a big chunk of why there's so many cuts expected is because there's a 35% probability priced in that short rates will be below 3% by the end of 2024. Below 3% from the current 550 now would imply a collapse, an economic, a significant economic deterioration, and the Fed being highly responsive to that significant economic deterioration. Do I think that that's possible? Of course, anything's possible. We could have a shock. Anything's possible. But the idea that there's a 1/3 chance that the Fed funds rate gets cut by 250 or 300 basis points or more over the course of the next year, that seems very elevated when you look at the basic facts, which is the economy's doing okay, and we just eased like all get out over the course of the last 8 weeks.
I can't make the numbers add up. There is interesting that in the core CPE, the core inflation rate, that shelter cost is 42% ish of what that inflation is measured at, and I could see staying higher for longer, which would keep well, let me tell you again. I could see cutting rates to get mortgage rates down a little bit, so people would start to sell their homes, so that we could actually get some turnover in residential. I could see that, but for pricing in that many, 0.75% cut means that you're 100% sure there's a recession. You're 100% sure the Fed's going to take extreme measures. They're going to reverse all their QE or QT, I should say, and that would only mean that you would have to have a real recession. And if the market is looking 6 to 9 months ahead, which is another canard I love, then somebody is really, really wrong here.
Right.
I know from, given that we were together 10 weeks ago, and I said recession was on the horizon. Now I simply ask, where's my recession? Right?
Yeah,
we have
recession. I love that.
light. We have recession light.
There you go, recession light.
Yeah, I would, we'll end it with that. But I would say the other key issue that I've harped on for the last 18 months is the U.S. economy today in 2024 is so significantly different than the economy that I started at Wall Street in '82 that you wouldn't recognize it. And I think we already had this pre-recession. I think the market priced in the recession before we had a recession because it just made so much sense to everybody because nobody knew. It was like flying an airplane with no compass and having the thing spin around. All these new inputs, all these new economic facts are all new. They've never been arrayed the same way that they're arrayed. And therefore, people were just, doing scientific wild ass guessing based on historical precedent that, in my book, does not apply to the economy in 2024. Human behavior never changes. I get that. But so much of the economy has changed and the nature of the economy. The 40% of people who own their homes outright.
Right. Yeah.
In 1982, that was 24%. You know how I know that? Because I have bardgoogle.com and it answers every question I have. Okay?
Yes, you do. Well, we'll definitely table that one because the next time we have Bob on, and hopefully it's not, we don't have to wait 10 weeks to have you back on, Bob, but we definitely want to talk about AI and all of that fun stuff as well. So Bob Elliott, he is the CIO of Unlimited Funds. Bob, thank you once again for joining us on Buy, Hold, Sell. We can't wait to have you back on and continue the discussion.
Oh, you're such a bootlicker, Todd. Jeez. I mean, come on, just take it down a notch.
Thanks so much for having me, Todd.
Absolutely. All right. Well, and also for the audience, go to unlimitedfunds.com to learn more about all the products that they have over there. And I think you'll definitely be pleasantly surprised, that's for sure. So I know we are as well. So, all right. So, Bob, if I don't reconnect with you over the next couple of weeks, happy holidays to you and yours, and to also to the audience as well. And on behalf of Bob Elliott and Tobin Smith, I am Todd Schoenberger. Thank you again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care. All right.
Buy, Hold, Sell, brought to you by CrossCheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.